Hi everyone. Today we're going to be working on Chapter 4, which is completing the accounting cycle. So this is our final step in the accounting cycle to wrap up what we brought in from chapters 1, 2, and 3. Now we're going to close out the period so we can get ready for the next one. So let's take a look and see what we're going to do first. We're going to look first at preparing a worksheet. So when we talk about a worksheet, we've actually already seen a lot of the parts of it. We're going to add a couple of columns, but the reason we use a worksheet is more just to provide a tool for us to prepare the financial statements. So it's going to aid in the preparation of the financial statements. It's just an internal tool that companies use. It's not something that you publish for anyone outside of the accounting department. It helps you to be able to check again to make sure that your debits and credits equal and make sure that you are recording your adjusting entries and that they equal. And then we do that adjusted trial balance that we learned in Chapter 3 and make sure that, again, the debits and credits equal. From there, we move the columns that go into the balance sheet into the appropriate columns, and the columns that go in the income statement into the appropriate columns. So hopefully by doing this, we've reduced some of our errors, made sure that we've checked everything, and it's going to help us prepare. So let's take a look. There are 5 steps that we're going to do for our worksheet. We've already done steps 1, 2, and 3 in chapters 3. So in step 1, we enter the unadjusted trial balance amounts from each of the accounts. Then we're going to get our totals and make sure that our debits and our credits equal. After that, in our next column, in that adjusting column, we're going to enter any adjusting entries that we're going to do. We're not journalizing them yet. We're entering them into the worksheet first, and then we're going to journalize them later. After we get those done, we're going to add up and again make sure our debits and credits equal to make sure we've recorded all of the debits and credits that we should for our adjusting entries. Then, just like in Chapter 3, we learned that we are going to prepare the adjusted trial balance after that. The adjusted trial balance just takes that balances from the unadjusted, includes any adjustments that we are doing in that second column, and it prepares that adjusted balance for each of those accounts. We again get our total debits and our total credits, make sure they equal. And then from there, we're going to take the accounts that go on the specific financial statements and put them into the appropriate columns. So we're going to put the ones that go into the balance sheet into the balance sheet column, and the ones that go in the income statement into the income statement column. And from there, we're going to be able to add those columns. We're going to see that they don't quite equal, and that's because the difference in them is going to be our net income or our net loss. Once we enter the net income or net loss, then we're going to be able to balance. So let's take a look at what the worksheet looks like. Okay, so if we look at the worksheet, we can see that it has, again, the list of our accounts that we've used. It has the unadjusted trial balance in the first green column. And then we go over to column 2, and that's where we have our adjustments. That's where we do our adjusting entries for that period. In column 3, we then take our unadjusted, put it into the adjusted balance, factor those in, and get our new balance. So we can see in supplies, we started with 9720. We adjusted 1,050, so that left us with a balance of 8670 in that supplies account. We get our totals for each of them. We can see that on all 6 columns, our debits equal our credits so far, and that's what we want to see. Then we're going to figure out what accounts go on the balance sheet. We know that we're going to see assets, liabilities, and our equity accounts on the balance sheet. Now you'll notice that it says balance sheet and statement of owner's equity. So if it goes on the statement of owner's equity and maybe not specifically on the balance sheet, that's okay to leave in there too. So we can see that we have our assets, which are here on the left in the debit column. And then we have our contra asset accumulated depreciation, and then we start with our liabilities. We have 3 liabilities: accounts payable, salaries payable, and unearned consulting revenue. And then we listed our capital, and then our withdrawal goes in our debit column. So those are the things that would go on the statement of owner's equity or the balance sheet. And then we know that on our income statement, we find revenue minus expenses. So we're listing our revenue accounts here. We had 2 of them. They go in the credit side of the income statement column. And we list our expenses. They go in the debit side of the income statement column because they have a debit balance. The next thing we're going to see though is if we total them. So if we total, our debits and credits in each of the columns do not equal. And that's okay in this time because we're going to add another column called net income, or another row called net income, that's going to be our balance. So if we have a positive net income, the way that we're going to get it is revenue minus expenses. So 8150 minus 4365 gives us a difference of 3785, which is our net income for this period. If it's a positive net income, you're going to add that to the debit side of the income statement, and you're going to add it to the credit side of the balance sheet columns. If we total after that, we can see that they then do balance. So this is our worksheet. And now from here, we can look and we can see exactly what to do on our financial statements. We can see that we go to the income statement column, and this is where we're going to pull the accounts for our income statement. Then we're going to do our statement of owner's equity, and the rest is going to go into our balance sheet. So we can find that, we can look at that from there. All right, so let's go into our next section. The next section talks about temporary accounts and closing at the end of the period. So first let's talk about what are temporary accounts and what are permanent accounts. So we can see here on the left that we have temporary accounts in the blue, and the temporary accounts are the ones that we're going to close at the end of every period. So we've seen most of these before. We've seen revenues, expenses, and withdrawals. We're adding a new account that we only use during the closing period. It's called income summary. So income summary is going to be used just during the closing period. It's a new account that we're going to use when we're doing closing entries. It's also temporary because we're not going to keep it open. It's just used during the closing process. So at the end of every month, we're going to be closing our revenue accounts, closing our expense accounts, closing withdrawals, and then eventually closing income summary. So because they're being closed, that's why they're called temporary accounts. They're only open temporarily, and we reset them at the end of every period. The reason we do that is because we want to measure what kind of revenue we have over a specific period. And we want to measure how many expenses. So revenue minus expenses gives us net income. We want to measure that income over each period. We want to know what kind of withdrawals have been taken out of the company. And when we close that, we're going to see that we close it and it reduces our capital account. So we want to see at the end of the period, how much equity does that owner currently have? And by closing withdrawals, we will be able to do that. The other side of it is our permanent accounts, and they're in orange. So with the permanent accounts, they are our assets, our liability, and then our owner's capital account. We're not going to close them. So we're not going to reset their balances every month. Assets are going to continue to build, and liabilities will have up and down as we increase liabilities and as we decrease liabilities. So they're going to change. All right, so the closing process, it's just 4 journal entries. So we're not adding a lot of new stuff into chapter 4. You're adding 4 entries. So the process is going to reset our revenue accounts, reset our expenses, and our withdrawals to 0 at the end of every period. When we're closing them, we're going to close them into our new temporary account called income summary. And it's exactly what it sounds like. It is summarizing the income of our company. So that's why it's called income summary. So to do our closing process, we first have to identify what accounts are we closing. Those are going to be our temporary accounts, the revenue, expense, and withdrawal accounts, and then eventually we're going to close the income summary account. Then we're going to record and post our closing entries, and from there we're going to prepare what we call a post-closing trial balance. The post-closing trial balance is going to give us our balances after we've closed those temporary accounts. So what are the balances in those permanent accounts? All right, so let's look at them a little bit more. So closing entries. Closing entries, we're going to have, first, we're closing our credit balances that are in the revenue accounts, and we're closing it to income summary. So if we want to make revenue 0. It has a credit balance. So to close it, we're going to debit that revenue account, and we're going to be crediting the income summary account. For expenses, they have a debit balance. So we're going to close their debit balances again into income summary. So to close a debit balance, we're going to credit the expense accounts, and we're going to be debiting income summary. Once we've done that, we can then see how much is in income summary, and that is our net income amount. We're going to close that income summary balance to owner's capital. If it's a positive amount in income summary, then we will see an increase to capital. If we have a net loss or a negative amount in income summary, we're going to see a decrease to owner's capital. And then finally, we're going to close the withdrawals account, which is going to reduce the amount of owner's capital that that company has, or that owner has. All right, so here's an example of the process. So here are the expense accounts that they have. Here are the revenue accounts. They have a withdrawal and a capital balance. So we're first closing our income statement accounts, which it's going to be the revenue. We're closing, it says to close income statement credit balances, which is the revenue account. So we're closing revenue first. You can see that it had a balance of $78.50. We're debiting $78.50, and that's going to let us close out that balance. For rental revenue, we had a balance of $300. We're debiting $300, and that's going to close out that balance. So revenue is now going to be 0. We're going to do the same thing with our depreciation or expense accounts. They all have debit balances, so we're going to credit them to make their balance 0, and we're going to debit income summary. We can see that the difference between them, the total amount of revenue and the total amount of expenses, is $37.85. That was our net income in the worksheet that we looked at a few minutes ago. So it has a credit balance, which means it's positive, it's net income, because revenue is $81.50, which is more than income summary. So to close it, we want to debit that $37.85, and we're going to be crediting capital. So that's going to increase that capital balance. The last thing we're going to do is close withdrawals. It has a balance of a debit of $200. We're going to credit it $200, and we're going to debit capital, which is going to reduce that capital. So our income is going to increase capital. Withdrawals is going to reduce capital. All right, so that's where we're going to stop for this section. And when we go into our next section, we're going to get into the post-closing trial balance.